Welcome to Beavers Wealth Management's April 2025 edition of Let's Talk Markets. As always, our goal is to educate and empower the families and businesses we serve. So if you find today's discussion helpful, please share it with others who might benefit. Okay, now let's acknowledge the obvious. We've got a lot to talk about. In this past week, it's been tough. Probably some of the most challenging days we've experienced in recent memory. Now, I do want to give a brief update on where things currently stand with tariffs, because the market is continuing to digest a great deal of uncertainty following the recent tariff developments. And before today, we really saw three potential paths forward. First was Trump begins cutting deals and tariffs are reduced. Second, Congress or the courts, they step in and they block or limit the tariffs. And third, Trump stays the course, initiating a realignment of global trade. And what we actually learned at lunch today was we kind of get a combination of number one and number three. Right now, markets are having a hard time anticipating what's the outcome going to be. And this is creating a lot of uncertainty. And I know I've said this many times, markets hate uncertainty. But let's also acknowledge the fact that today, the market had one of its best days in history. For some perspective, it was actually the third best day post-World War II that the market has ever seen. Second best day for the NASDAQ ever. But at Beavers Wealth Management, we're actively monitoring these developments every day, paying close attention to how this plays out across trade, earnings, and market sentiment. And as always, we remain committed to keeping you informed and prepared through whatever is going to come. And we've talked extensively in previous episodes about the ongoing tariff issues, market volatility, and what they mean for investors long term. So if you're looking for more insights specifically on tariffs and our market outlook in this volatile environment, I encourage you to revisit our February and March editions of Let's Talk Markets, and those are available on both our YouTube and Spotify pages. But today, our focus is going to be different. Today, we want to take a step back. Let's cut through the noise, and let's put these recent events into a broader perspective. Because by understanding market behavior through a clear, data-driven lens, we can make informed decisions based on facts rather than fear. We truly appreciate you joining us today. So we're going to dive in, and we're going to put the current market into some clear perspective. Now, let's take a look at what we've seen just up to the beginning of this week. Now, a lot has changed today, obviously with the markets rebounding so quickly, but to give you an idea, the S&P for the year was closing in on almost down about 15% for the year. The NASDAQ hitting bear market territory as well, down over 20% for the year. But if you look at the three worst performing sectors, as we typically do with this, information technology, consumer discretionary, and communication services, all down about 20%. So some pretty significant declines in those. The best performing asset class out there or sector, consumer staples, utilities, and healthcare. Now, what's interesting is if you look at the inflation number currently stands at the CPI at about 3.1%. Unemployment at 4.2%. So we're seeing a little bit of a tick up in unemployment, but actually a tick down in overall CPI. And we'll monitor that closely as we see some of these tariff effects over the course of the next several months. Now, let's be honest. When markets get volatile, emotions run high. It's natural to feel concerned when headlines highlight uncertainty and market swings from day to day. It's like anytime you put it on the TV, you see it. Markets sell off and the biggest writing you've ever seen. It creates that fear. But as investors, our most important responsibility is to take a step back. Let's set emotions aside and focus on what the data is telling us. Because at Beavers Wealth Management, we rely on a disciplined, data-driven approach. Because history consistently shows us that a disciplined investing decisions, not emotional reactions, are what lead to long-term success. I mean, today is the perfect example of that. Can you imagine if you'd gotten out of the market yesterday and the market was up almost 10% today? You lost essentially a year's worth of return in one day. That's why today we're going to dive into several charts and visuals designed to put the current market into clear perspective. By understanding historical patterns and data-driven insights, we can approach volatility not with fear, but with clarity and confidence. And so lots of fun slides today, so I hope you're ready. Let's jump in. Let's look at this first slide. This is the S&P 500 index volatility. And what it does is shows the number of days with greater than 1% moves. So let's begin by acknowledging something we all know. Volatility is a natural part of investing. Take a look at this first chart. It shows how many days each year the S&P 500 index has moved by more than 1%. On average, since 2009, we've seen about 65 days per year with significant ups and downs. That's roughly 1 out of every 4 trading days. This frequent movement reminds us that volatility isn't unusual. It's a regular feature of investing. Okay, slide number 2, a history of market corrections. So let's build on this point, right? This next slide puts market declines in historical perspective. Market corrections, those declines of 5%, 10, 15, or even 20, they occur very regularly. For instance, corrections of 10% or more typically happen about every 16 months, lasting around 4 months. The most recent occurred just last month in March. But knowing these corrections are frequent and temporary can help us keep calm during turbulent times. All right, I love this next slide. It's the history of U.S. bear and bull markets. So if you move deeper into history, let's look at the cycles known as bear and bull markets. This chart tracks market expansions and declines since 1942. Notice that bear markets, which represent significant downturns, right, a 20% decline from the peak, last about 11 months on average, with a decline of roughly 32%. But bull markets, the upward periods, have historically lasted over 4 years, averaging cumulative returns of nearly 150%. So what's the takeaway here? Even significant declines are relatively short-lived compared to extended periods of growth. But we know those short times, they can be painful. Slide number 4, the probability of positive returns. I love this one. Here's an important perspective to consider as we move forward. The longer you stay invested, the better your chances of seeing positive returns. This slide clearly shows that while there's about a 53% chance of seeing positive returns in a single day, the probability dramatically increases to nearly 98% over a 10-year investment horizon. So in other words, patience in investing greatly increases your likelihood of success. All right, so let's transition this a little bit and how you as an investor are rewarded for staying invested. And understanding that short-term volatility, it's common, leads us directly into our next important point, the tangible rewards of staying invested through market turbulence. This slide is mind-blowing to me. This shows missing the best days in the market. All right, so consider this powerful illustration. So what happens if you miss just a few of the market's best days? From 1979 to early 2025, a $10,000 investment in the S&P 500 would have grown to 1.6 million. But missing just the best 5 days cuts that amount significantly to about 1 million. So during that whole period of time you missed the best 5 days, 1.6 goes to 1 million. What about the top 30 days? Your investment drops now to around $260,000. This emphasizes the importance of staying the course and remaining invested, especially through volatile times, especially on days like today, where the market was up almost 10%. All right, slide number 6. The S&P 500 index performance after its worst days. Kind of a different perspective here, but it further reinforces the point that we're trying to make. So let's examine how the market historically recovers following its worst days. Right? We saw some of the worst days we'd seen last week. Look at what happened today. But this chart shows that after the most significant single-day declines, the S&P 500 tends to rebound strongly. On average, 1 year after these major downturns, the index returned about 30%. After 5 years, the returns averaged about 12.5% per year. This clearly demonstrates the resilience and reward investors experience when they resist panic and they remain invested. All right, this next slide. The S&P 500 index going through the positive and negative years since 1926. So let's kind of broaden our historical view even further. Since 1926, the S&P has had positive returns 74% of the time, averaging around 21.5% in those positive years. Whoa. Even in negative years, losses averaged around 13%. This historical trend highlights that despite inevitable downturns, we know they're going to happen, markets have overwhelmingly favored long-term investors. Next slide, crisis and events. We've talked about this one before, but since 1970, you take a look at this comprehensive chart, tracing the growth of a $10,000 investment since 1970. Despite numerous global crises, we have wars on here, recessions, financial crashes. This investment would have grown to nearly $2.9 million by early 2025. Each event triggered short-term volatility, but as history clearly shows, long-term investing has consistently rewarded patience and discipline. All right, so a ton of information that we provided here with lots of slides, but what's the bottom line? Volatility in 2025, it shouldn't come as a shock, right? We've been talking about this coming in the last year of Let's Talk Markets. After 2 solid years in 2023 and 2024 and a new administration, we expected this year to bring some turbulence. Like Ryan said in his market fact last month, there's no upside without occasional downside. No reward without risk. Now, while we're cautious in the short term, we are absolutely bullish on the markets long term. And we have good reasons for it. Because times like these remind us of the importance of stepping back, ignoring reactionary moves triggered by daily headlines, and most importantly, having a solid plan in place. At Beavers Wealth Management, we don't just talk about plans, we proactively implement them every single day. Our job is not to anticipate, not react. It's continually evaluating risk and opportunities to ensure you're positioned to not only navigate this volatility, but capitalize on it. And you may have noticed adjustments to portfolios at the beginning of the year and just last week prior to the tariff announcements. Because ultimately, we're here to give you confidence, clarity, and peace of mind, knowing you're not alone to navigate the market's inherent unpredictability. And so that brings me to our second opinion service, which I've talked about before. As we've seen recently, market volatility can create significant uncertainty, and the people you care about may be feeling unsettled about their financial future. If you have a friend, family member, or colleague who could benefit from a trusted second set of eyes on their investments, now is the perfect time to introduce them to our second opinion service. We created this service so that anyone can come to us with their current investments, financial plan, or strategy, and just gain a fresh perspective, ensuring their investments align with their unique goals and provide the reassurance that they're on the right track. So if someone you know could benefit from this clarity, we encourage you to reach out to us anytime. We'd be honored to help. As I said before, we're so grateful you joined us today. Thank you for taking the time. And we encourage you to share this content with anyone who might find it valuable. And we have the replays of all of our Let's Talk Markets posted on our new YouTube page and the video podcast format on Spotify as well. I hope you're enjoying that new page. YouTube and Spotify, they're also home to episodes of our podcast Between the Bears and the Bulls. We've actually released a few new episodes this year, so make sure to check that out as they're coming out monthly. And if you have any suggestions on what you'd like to see from us, please let us know, because we want to make sure the content we're putting out there is valuable for you. Oh, okay, and one last thing before we go. I know the Masters, they start tomorrow. So I was listening to a reporter. He was interviewing one of the golfers, and he was asked, why do you always bring 2 pairs of pants to the Masters? His reply, in case I get a hole in one. All right, we'll see you next month for May's edition of Let's Talk Markets. And don't forget, leave it to Beavers.